Good evening. My name is Nicholas Gage, and I am the chairman of the Hellenic-American Cultural Foundation. Tonight, we have a rare opportunity to hear from global experts on the Greek debt crisis, how it developed and how it was resolved. The importance of the discussion is not limited to any particular time or place, but has global implications. Those who cannot remember the past are destined to repeat it. So a thorough understanding of the financial conditions which gave rise to the crisis and the steps and actions taken to contain the crisis are critically important. The Foundation is very fortunate to have with us two renowned and distinguished experts on the Greek debt crisis, Dr. Charles Dallara and Professor Charles Calomiris. Dr. Dallara is a highly experienced and respected international economist who spent much of his career dealing with sovereign debt and global financing issues. He is the author of Euroshock, How the Largest Debt Restructuring in History Helped Save Greece and Preserve the Eurozone, which will be for sale at the reception. Professor Charles Calomiris is a financial policy expert and director of the Institute for Research in Economics in Washington. He is the co-author of Fragile by Design, The Political Origins of Banking Panics and Scarce Credit. In addition, the discussion will be moderated by Clive Crook, a highly regarded Bloomberg opinion columnist and member of the editorial board covering economics. There will be a reception following the event, so please join us and take advantage of the opportunity to interact with the speakers and other attendees. Now, let me turn it over to Nick Gage, a member of the Foundation's Advisory Council, who will introduce Dr. Dallara, and then to Marilena Christodoulou, a member of the Foundation's board, who will introduce Professor Calomiris. Thank you.
Before I launch into my happy assignment tonight to introduce my good friend Charles Dallara, I want to congratulate Nick Gage and his cohorts for organizing so many intriguing and compelling programs for more than a decade now, including this sold-out event tonight. So I think it's appropriate as we begin a new year to give them all a round of applause. Now to my task at hand, to tell you something about Charles Dallara. Despite the similarity to his name to the famous Greek singer, Yorgos Dallaras, Charles is not of Greek origin, proudly being the progeny of an Italian father and an Irish mother. But Charles is no newcomer to Greece and no stranger to the colorful character of the Greek people. He lived in Athens for 2 years as a young naval officer stationed in Piraeus, serving as navigator on a guided missile destroyer chasing Soviet submarines around the Mediterranean. During that time, he came to admire the Greek people, their amazing history and culture, and particularly their distinctive cuisine. After the Navy, Charles used the knowledge he had acquired in several top American universities to become an international economist and served at the US Treasury in senior positions under Presidents Ronald Reagan and George H.W. Bush. As a result of the reputation he had achieved in those positions, he was then given the helm of the Institute of International Finance, a global association of banks and investment firms that had lent a lot of money to Greece. It was from that perch that Charles found his way back to Greece. In 2010, the euro crisis exploded with Greece at the epicenter. Charles was asked to step in and to negotiate what turned out to be the biggest restructuring in the history of the world. This successful restructuring, which wiped out over $100 billion of Greek sovereign debt, helped stabilize Greek finances and eventually contributed to the remarkable recovery of the Greek economy, which we've seen in recent years. Although Charles came to love Greece and to admire what we have achieved as a people over 2 millennia, he has also been instrumental in encouraging the economic reforms which the government of Kyriakos Mitsotakis is following. At the same time, he's never short of new proposals which can strengthen further the long-term competitiveness of the Greek economy. Unlike most analysts, however, Charles did not hesitate to put his money where his mouth is. After dealing with the Greek crisis, Charles went into private equity as a principal in Partners Group, a Swiss firm that he guided into making major investments in Greece, including paying $1 billion in 2021 to buy one of Greece's leading pharmaceutical firms, Pharmathen. Charles' book, Euroshock, describes in detail the exceptionally difficult negotiations in which he was centrally involved. His role was pivotal in ensuring that Greece remained within the Eurozone and was given the opportunity to recover from its near economic collapse and return to a path of growth. His tough love for Greece, his faith in its future, in persuading his firm to make big investments in the country, and his unshakable attachment to the country throughout his life moves me to correct what I said earlier, that Charles is not Greek. The great Greek teacher and philosopher Socrates wrote, "The man who shares our highest thoughts is a Greek in a truer sense than he who shares merely our blood." By that definition, Charles Dallara is as Greek as anyone I know. I hope you enjoy the evening with him. And you enjoy his book as much as I have enjoyed the time I have spent with both. Thank you.
It is my great pleasure to introduce Charles Calomiris. Professor Calomiris, as Nick mentioned, is a distinguished academic economist and an expert in financial policy. He's the director of the Institute for Research in Economics in Washington, D.C. Previously, he was the Henry Kaufman Professor of Financial Institutions at Columbia Business School and the director of its Program for Financial Studies. He also served on the European Union Systemic Risk Board. I personally met Charles in March of 2010 at the very beginning of the Greek crisis. At the time, I was a trustee of the Greek Orthodox Cathedral, and our cultural committee had decided to organize a lecture on the Greek crisis, which was a big issue with the Greek community. Several of my fellow trustees are in the audience this evening. The problem was that none of us was an expert on what to talk about the Greek crisis. So we had to find a brilliant economist, and preferably Greek. Actually, my husband Iris deserves the credit for finding the expert. Iris is an alum of Columbia, and he said, well, there's this brilliant guy at Columbia, and he sounds Greek. And I'm going to contact him for you. And the rest is history. Professor Calomiris' event in March of 2010 at the Cathedral Hall was, a huge success, such a huge crowd that people were standing on the street outside the lecture hall. They didn't want to leave. They couldn't hear anything, of course, on the street. And I'm not going to tell you what Professor Calomiris' initial analysis on the Greek crisis was, because I'm sure he will, but I'm very eager to hear what he has to say 16 years later. So, thank you.
Well, first, let me join Nick Gage in thanking Nick Corradis and his colleagues, including Marilena, for organizing this special evening here. It's an honor to be with you. It's an honor to be sharing the stage with two such distinguished financial experts and economists as Charles and Clive. And I really feel privileged to be considered an honorary Greek, Nick. You know, when I think back to the time when I first arrived there as a young navigator on a destroyer, I was told that we would eventually be based in Piraeus, which we were. But initially we were told you have to go anchor in the Bay of Eleusis. And I quickly did a little bit of calculation and realized that the Bay of Eleusis is all of 5 miles from the Bay of Salamis. And there's no one in this room who doesn't know what happened in 480 BC in the Bay of Salamis. And certainly I don't imagine myself as a modern day Themistocles, far from it. But it was a moment of awe and inspiration for me. And I've taken that awe and inspiration about Greece with me in every endeavor that I've been involved in. Nick, you were much too kind in your remarks, and I thank you for that. But I also thank you for your friendship you've extended to me over these past years and for the continued willingness to deepen my understanding of Greek culture, Greek politics, and everything Greece. So it's been very, very kind of you to share your vast knowledge and experience. The Greek debt crisis was an extraordinarily difficult period for Greece. I don't need to tell that to anyone in this room because you all probably lived through it directly or indirectly through business interests, through friends, through family, through relationships, or through simply looking at the painful news in the newspapers and the TV every day. Just to give you an idea of how severe it was, the collective collapse of the GDP, the scale of the Greek economy, approached 25% at the nadir of this crisis. During my long career now of almost 50 years in managing sovereign debt issues, I've never seen another industrial country go through anything approaching that, except in wartime. There hasn't been in Europe a major economy that has suffered anything close to that degree of contraction outside of this painful experience. Unemployment reached almost 30%. Youth unemployment pushed upwards of 50%. Almost 1 million people, as you probably know, some of the cases firsthand, left Greece to go for better horizons. Suicides spiked very painfully. This was a country that was put under such tremendous economic pressure that it's a great tribute to the people of Greece that it has survived, and not only survived, but now is in the process of a remarkable recovery. But let me just share a few points about how it happened, how we tried to deal with the problem, and what some of the outcomes were. And then I look forward to hearing from Charles and opening the discussion here. The crisis erupted, as Nick mentioned, beginning actually in the fall of 2009, after the election of Prime Minister Papandreou, when the current finance minister announced proudly that they were inheriting a 5% fiscal deficit. The markets were very comfortable with that idea. Unfortunately, a few weeks later, the minister came back to the podium and said, oh, we've now studied the numbers a little bit more carefully, and it's now 8%. The markets still were kind of just moving along, ignoring these numbers. Unfortunately, a few weeks later, the numbers were announced at a deficit of 11%. This was all about 1 year's numbers. I think the fiscal year may be 2008, Charles. A few weeks later, everything hit the fan when they announced that the deficit had now been revised up to 15%. And from that moment on, a crisis unfolded around Greece. Keep in mind that this came in the aftermath of the global financial crisis, so markets were already on edge. Ireland had already slipped into a real estate-driven crisis, so Greece was not alone. And in fact, it was subsequently joined by Italy, Portugal, Spain, even Iceland, far up north, ended up in a crisis. Fortunately, at that time, there was no crisis in Greenland. But I think it's important to recognize that there was a global and a European context to this. Greece had decided, and I think it was the right decision at the time, and still remains the right decision, to join the Eurozone. They gave up control of their currency. They gave up their currency. No more drachma. They gave up independent monetary policy. Both of these were sacrifices the Greek government was willing to make in the interests of longer-term stability. Unfortunately, when they did this, the markets decided, aha, this is a wonderful opportunity because we can loan a lot of money to Greece. We'll get better returns because it is Greece and the economy is not as strong as Germany, not as strong as the Netherlands, et cetera. So we'll get better returns and we'll get the protection of the Eurozone. And if Greece ever gets into trouble again, the Germans will probably bail them out. The markets had a great time making money, lending to Greece. There was, unfortunately, not just a global and a European context to this. The Greek economy, to be honest with you, in my view, had not been terribly well managed in the decades since the end of World War II and the Civil War. Alternative governments, sometimes new democracies, sometimes PASOK, you're all much more familiar with this than I am probably, managed to create a system of clientelism, of favoritism, of spread of government bureaucracy that bred more and more inefficiency in the Greek economy. The result of this was not a terribly productive economy, and when they began running even larger fiscal deficits, facilitated by this excess financing from the markets, there was bound to be a price to pay for this. And so when this crisis erupted, the markets began to study Greek economy and began to realize just how fragile and how weak it was. We were called in because the creditors asked me to represent their interest. And I quickly realized that this was going to be a very difficult negotiation. How do you convince bankers that they should give up billions of dollars of loans in order to save Greece and save the Eurozone? We had one thing going in our favor in persuading the bankers to do this. They knew that the debts that were owed to them by Greece were 1/4 of the size of the debts that were owed to them by Italy. So if they could not stabilize the Greek economy, they knew that the Italian economy could also explode in their face. As Charles and Clive know oh so well, there is no clear playbook for sovereign debt restructurings. Some of you may have seen that Saks, the holding company of Saks Fifth Avenue, filed bankruptcy today. Well, there's a playbook for that. There's an entire legal framework for Chapter 11 for resolving bankruptcy in the US court system. Globally, there are some vague rules of the game, but there really are no ironclad rules. And so we set about trying to find a common framework for negotiating the resolution of this debt crisis. Unfortunately, the Eurozone was not prepared for this. The IMF came in with a very heavy hand and decided that the solution should be successive rounds of belt tightening. Well, when you force belt tightening on a sick patient already struggling to survive in the recovery room, you don't really generate solutions in the short run. And the Greek economy went through this painful period that really extended for a full decade, from 2009 to 2019. We actually concluded this restructuring in 2012. As Nick said, $107 billion was wiped off the balance sheet of the banks in order to give a breath of fresh air and a window of opportunity for the recovery of the Greek economy. We took another $100 billion of debt and stretched it out over concessional terms over 30 years. At the same time, Europe was very undecided as to how to go forward because there had been a great reluctance to admit that a member of the Eurozone would have to restructure its debt. And some European leaders actually wanted to force Greece out of the Eurozone, including the German finance minister. That would have been an historic mistake, and I admire the resilience of the Greek people and the leadership of Greek governments in resisting that. If there was one savior in all of this, this story doesn't really have a lot of heroes. The bankers, the managers of the Greek economy, the Europeans, the IMF. But if there's one person that I think made a difference in helping us reach agreement on this restructuring, it was a technical prime minister that led Greece for all of 7 months, Lucas Papademos. And although I have admiration for all of the leaders of Greece before and afterward, none of them brought the credibility and the skill set that Lucas did. When Mitsotakis was elected in 2019, and there had been a few modest efforts toward the end of the Syriza period at stabilizing the Greek economy, we began to see a series of systematic economic reforms, which has been carried forward now for some 6 to 7 years. Fiscal discipline returned to Greece. Some improvements in the efficiency of government were instituted. The government service systems were digitalized. Mind you, there's still a lot more to be done. And I never go to Greece without seeking an audience with one of the leaders of Greece to share my views about additional measures that should and could be taken. However, I come away with a good sense of optimism about the economic future of Greece. Part of this has to do with the remarkable resilience of the Greek people. When they elected Syriza, in my view, this was a cry for help. This was a message to New Democracy and PASAK. Guys, we're tired of you. You haven't managed this country terribly well, so we're going to give someone else a chance. However, it was clear fairly soon that Syriza was really not, in my view, capable of effectively managing the Greek economy or negotiating with European leaders. They began to stretch the fabric of democracy in Greece. And yet, it never ripped. The Greek resilience was so strong that they finally said, okay, guys, New Democracy, PASAK, we're going to give one of you another chance. It turned out to be New Democracy, and they have taken the baton, and they've taken a lot of strong measures. I think that we in this country, celebrating the 250th anniversary of our founding, took a page out of the history of classical Greek history when we took the principles of democracy that Greece had created in that special century, 5th century BC, I guess it was. And we improved upon it. There's no doubt that the Constitution, the various documents that formed the basis of our democracy was built on the principles laid out by Greece. Today, we are stretching the fabric of our own democracy in this country. And I think we once again can take a page out of a more modern Greek book by looking at what's happening and telling ourselves here in our 250th year, it's time to restore, refurbish, and strengthen the resilience of our own democracy, just as the Greeks did in the last decade. Thank you for your time. Let me turn the floor over to Charles.
Hello, everyone. Thanks to the organizers and congratulations to the Hellenic-American Cultural Foundation. What a great event this is, and how encouraging it is to see so many people show up to talk about this topic. I wish this were more something I was used to, because I think financial crises are pretty important. And I also want to thank my panelist colleagues, and especially Charles, for writing this book, Euroshock. So I can recommend it to you highly. It is a unique insider's account of the period, the whole year 2011 and early 2012 until the agreement was reached on the restructuring of the privately held debt. It is incredibly detailed. So what you learn as reading this book is that Charles took copious notes throughout his meetings, and he's able to quote what people said in private meetings. I hope they're going to be happy with that, Charles, at great length. There is no other account of this. So as a historical document, this is actually incredibly useful. Again, the period is all of 2011 and early 2012. Just to give you a timeline there, they luckily, I would say, reached agreement in early 2012 before Syriza took power in June, were elected in June 2012. The arc of the book, and it's a useful sort of thing to think about a book having an arc, the arc of the book can be summarized mathematically as the evolution from the number 20 to the number 73. That's basically, every chapter of the book, you start with what the creditors were expecting to lose in terms of the present value of their investment. They started expecting to lose 20%. And by the time of the agreement, they had realized they had to lose 73%. Now, there are many different ways to look at that arc. Why does it take so long to reach agreement? One answer, which Charles, I would say this is the answer on which he's going to give the greatest weight. I'm not saying it's the only answer you give. I would give it less weight, is that the IMF was unnecessarily intransigent about the criteria that it would find acceptable for the debt write-down. And so everyone else seemed to be willing to go with, let's say, the number 20, at some point the number 30, the number 50, but the IMF staff kept pushing that that wasn't going to solve the problem. You needed a deeper write-down. And I agree with Charles that that analysis was incomplete, as you pointed out. They've since changed that, and that it wasn't perfect. But another view, so from that perspective, you'd say, well, if the IMF hadn't been so intransigent, maybe you could have reached an agreement earlier, which would have been very beneficial, of course. Another view, though, is that the reason it took so long was that the creditors, the private creditors, were too optimistic. They were expecting too little a write-down when all along there needed to be a very large write-down. Now, I put a lot of weight on that view. And I don't just put weight on that view in hindsight, but if you were there in March 2010 when I was doing my own economic analysis of what the size of the problem was, I concluded that even if Greece reached structural reforms, which I'll talk about in a minute, that solved its growth gap between Greece and, let's say, Germany or the Netherlands at that time, even if they did that, the size of the write-down that would be necessary to put them on a sustainable fiscal path was very large. And that I actually analyzed it from the standpoint of how big a change in expenditures or taxes was needed. And my conclusion was, in March 2010, that alongside structural reforms, if those could be done immediately with a snap of a finger, there'd have to be an immediate and permanent 50% reduction in expenditures, or roughly 50% increase in taxes, immediate and permanent. No country in the world has pulled that off. Estonia came close in the early 1990s, but Greece was not politically or culturally or historically Estonia. Estonia actually was willing to take incredible harsh medicine in 1991 because they had faith in their ability to have a reset and to grow. They were coming out of the Soviet period. There's a lot of stories there about why Estonia was a kind of very entrepreneurial, sort of pro-growth, pro-market environment. That wasn't true of Greece at this time. And so my own analysis was, first of all, we're not going to get those structural reforms right away, which I'll talk about why that's so important. And secondly, it's not likely that we're going to get the fiscal reforms. And so there needed to be a huge debt write-down, and that was visible in my mind as early as March 2010. And I just want to emphasize that's a big part of where I think it took the world a long time to see that the write-down needed to be so big. Interestingly, Charles, in your book, you talk about a meeting that you had with your good friend Paul Volcker early on in the process. And you talk about how Paul Volcker said, you guys are way off. It needs to be a much bigger write-down. So I put myself into good company in thinking that there was a lack of realism. What I want to spend 5 minutes talking about, though, was how this problem of lack of sort of realism was really there from the beginning at the launch of the euro in the first place. And that there was also reasons why that willingness to lend at spreads that were paper thin above the German spreads to Greece actually aggravated the problem quite a bit. So that I think the unrealism of the analysis of the what eventually were called the PIGS, Portugal, Ireland, Greece, and Spain, the lack of sort of recognition of how deep those problems were really goes to the beginning of the process. I want to tell you about a few conversations and perspectives on this, now again, pre-2011. So let me start with 2009. An Irish economist writes an academic article where he surveys all the economists' opinions about whether the euro was going to work, which were written, my own included, in the late 1990s for the most part. And what he intended this article to be was a teasing of American economists. Because as he said, virtually every American economist said that there was no way this thing was going to hold. Whereas in Europe, 50% of the economists who wrote articles about it believed it would hold. Now, he intended this as teasing the American economists for not realizing, because it was 2009, a decade almost after the euro had been founded, that we were too pessimistic. If he had just waited a year, the point of his article would have been clear to him, which is the Europeans were way too optimistic. So what was it that economists were pointing to? And I'll also tell you about a conversation that Alan Meltzer had with Helmut Kohl. So Helmut Kohl was, I would say, the architect of the Eurozone. Helmut Kohl grew up in the part of Germany that was right next to France. When he was a little boy, he went around at all these old ruins. And what were those ruins of? They were ruins of wars between Germany and France for hundreds and hundreds of years. That mattered to Helmut Kohl. And he saw the euro as the sort of nail in the coffin of European war. That was the way he looked at it. And he was explaining this to one of my best friends at a conference in Germany. And my friend turned to him and said, well, I agree that you can create the euro based on your political desires, but whether it will work will come down to economics. Now, what were the two economic principles that the skeptics, all American economists, were pointing to that led to their view that this wasn't going to work? There are two things that make a currency zone not work. One of them is different fiscal paths. So if you and I form a currency zone and your country has been spending money like a drunken sailor and has a very high debt to GDP ratio and appears to be on a path to continue to do that, then our agreement's not going to work. You're going to eventually run into the problems that Greece and Portugal did, which was fiscal non-sustainability. Another thing that could lead to a problem, even if you didn't have a fiscal problem, would be lack of competitiveness in the international sector. So we call this productivity growth in the tradable goods sector. And Greek productivity growth was lower than the average for the Eurozone, and certainly lower than the center countries in the Eurozone. So both trends were extremely unfavorable. And if you were analyzing this using Nobel laureate Robert Mundell's framework for sustainability of a currency zone, for which he got the Nobel Prize, you would have analyzed that this didn't make sense. And by the way, those two influences tend to aggravate each other. If you have poor performance in your tradable goods sector and a recession, that's going to create more of a fiscal problem. And so it wasn't a very optimistic moment for us when the Eurozone was created. You could also see some really scary things going on. The Maastricht Treaty that had created fiscal criteria was purposely relaxed, both for Italy and for Greece, so that they could do accounting gimmicks to use swap transactions to make the fiscal deficits and government debt outstanding seem lower. This was done at the time of the entry of Italy into the Eurozone and at the time of Greece into the Eurozone. In other words, people were using gimmicks to hide fundamental trends from the very beginning. And there were big persisting differences in productivity growth. Now, why were there differences in productivity growth? Because in Greece and in a lot of those other countries, there was a kind of inefficient, and you might even say politically corrupt, economy that wasn't able to allocate resources as efficiently. I could go through the examples, but of course we're seeing now, I'll come back to that, in the success of the current regime in Greece, we're seeing how those reforms are having the opposite effect, very favorable effects on productivity growth. But at the time, this was deeply institutionally embedded. By the way, Ghana had a better corruption score, according to Transparency International, in 2011 than Greece did. Cyprus had a much better one. Greece was really at the bottom of the Eurozone in terms of that corruption. I'll give you an example of how corruption creates inefficiency. If you how many of you took vacations in Greece in the 1990s? I bet almost everybody, right? And the typical experience you would have as a tourist there, suppose even if you had some money, is you'd stay in a 3-star hotel in some city or town in Greece. They were kind of not great. None of them had a spa, none of them had a golf course, none of them had any of that. Why? They were legally barred from it. Why? Because that was a way of protecting the local 3-star hotel owner. So you hoped, well, why would the greatest beaches and mountains in the world not have first-class resorts? Because they were illegal. So the Amman resort finally comes in after the crisis, right? All those resorts, because they can start doing things. That's how corruption creates inefficiency. Now, the McKinsey Institute wrote a wonderful book in 2012 called A 2020 Vision for Greece. And what they said was, all of Greece's specializations, tourism, agriculture, they're not bad ideas as sectors of specialization, but all of them are done hugely badly. Tourism is just inefficient. The oil industry in Greece, Greece has great olive oil, great olives, but they don't market them and they don't produce them and sort of get them to market in a way like other countries. So I just want to emphasize, this was all out there. And I know I don't want to abuse the privilege and go over time, but just to say, that's what we were all talking about in the 1990s before the entry of the Greeks and others into the Eurozone. Now, what we didn't expect was that the bond market would be so favorable toward these sovereign risks of the Greeks and the others, the Portuguese especially. And the reason we didn't expect it was because we thought that it was so obvious that the risks were high. And you see this made things much worse, because if you're lending money, that means you can accumulate debt much faster. So they were too willing to lend money cheaply. Now, there's another story here which is very important. If you're at a competitive disadvantage in your traded goods sector, but you want to, as the political leaders of Portugal or Greece or Ireland or Spain, you want to avoid recessions, what are you going to do? You're going to subsidize the non-tradable goods sectors so that they keep the economy on float. What are those non-tradable goods sectors? Real estate and government. Real estate is the Irish and the Spanish thing. Risk subsidies through the banking system that subsidized real estate in an unsustainable way. Why? To counter the fact that you're actually inefficient and uncompetitive in your tradable goods sector. And in Greece and Portugal, government spending activities as the substitute for your inefficiency. So there was a, we say, endogenous, predictable worsening of the position of these countries as the result of coming into the Eurozone. They were in an unsustainable position as partners from the beginning. So I don't want to beat a dead horse. Now, when I was the first public debate I did on this in 1999 at Columbia was with my colleague, Robert Mundell. Now, do you get the irony? Robert Mundell won his Nobel Prize for explaining everything I've just explained to you. I am not kidding. That is not an exaggeration. And yet, he was now the economist who was pitching the Eurozone. Now, what was his explanation? He said, look, it's that very problem that's the reason Greece should join the Eurozone. It's their unsuitability that makes them suitable. I'm not making this up. And this story was actually quite popular in the early 1990s. It was what we call the tail wags the dog. So the idea was, think about Argentina adopting convertibility in 1991. Why? Because they had a huge fiscal unsustainability problem. And the view was, if we create convertibility, an exchange rate of 1-for-1 with the dollar, that will force them to fix their fiscal problem, because if they don't, they're going to have such a big financial crisis that they'll be destroyed. So obviously, being rational like all people, the Argentines will fix their fiscal problem. That's the logic. Well, that logic was completely discredited by 1999 in Argentina, and yet it was exactly the argument that my friend and colleague, the late Robert Mundell, was using to explain why the Eurozone made sense. So I think that was quite strange. Now, coming back to 2010, it was a real downer. The event that Marilena talked about, where I was speaking, I was really in a hard position, because there I was saying, look, guys, I wish it were possible to keep Greece in the Eurozone, but I really don't see how it's going to be possible. That was before the private sector was doing a 73% debt write-down. But even at that, the assumptions that would have been necessary would have been to accept the need for structural reforms, which were politically, there was a lot of resistance to. I almost got run down by a mob in Syntagma Square in 2012, okay? And I took a group of MBAs to Greece in 2013 to see what was going on in the Greek economy. There was lots of green shoots, by the way, lots of cause for optimism, but the politics wasn't one of them, because Syriza had taken over, and there was a lot of just blaming everyone but ourselves, is what it came down to, right? So I have to say, I was saying, I don't see the point of going through all the suffering if you're going to have to leave anyway. So if you're not going to do the reforms, maybe you should exit. While I agree with you that was not a good idea, but I didn't see really any practical solution to it. I'm almost done. So was I right about that? I would say, sense yes and a sense no. So what's the sense yes? Well, staying with the Eurozone cost Greece 10 years of no growth, 25% cumulative loss in GDP, and a 10% decline in its population. Pretty big suffering. But on the other hand, despite all the resistance to reform, here's the thing. Reform ended up kind of happening. I mean, it's not done yet, but in the last 5 years, it's looking pretty good. So I don't really understand. You could say, how is it that Greece hung in there and actually did it? Now, my good friend Athanasios Orphanidis, who's the former head of the Central Bank of Cyprus and a professor at MIT, at the time he said to me, Charles, you're wrong about Greece not being able to do it. He said, the answer is they will do whatever it takes eventually to stay in the Eurozone as a symbol of wanting to belong to the club called Europe. And I think that he was right, it turned out, But the suffering, you could say, maybe you might say, eventually the tail did wag the dog, but the dog almost died. So I'm not sure about that argument. Now, if you look today, though, in light of those reforms, land reform, privatization, government expenditure reductions, tax collection, anti-corruption measures, just a wonderful series of things that's been happening. What you see in the data is that the productivity growth difference between Greece and the rest of the countries has basically been closed. And the fiscal trajectories of the countries, Greece is on a better path now than, let's say, Italy, and certainly better than France. And so now the irony is Greece is actually an outperformer in the Eurozone, and I would say its prospects look really good. Energy, by the way, if you haven't kept up, last year was a really big year for energy reform in Greece. Greece now produces 3/4 of its energy consumption is from renewables, and the remainder is going to be from liquid natural gas coming from the US, which is a huge improvement, and it just puts Greece in a wonderful position economically and also, by the way, geopolitically. Within a few years, there will be no dependence at all on Russian gas. I would say that the potential for that success was always there. When we were there with the MBAs in 2013, you could see a lot of great entrepreneurial stories in Greece. We went to the Faggot factory, we went to the Gaia winery, we went to the Amman resort, we went to a lot of places. And when we talked to people at Procter & Gamble, what they said was, we love Greek workers. They work hard, they're smart. And so the educational achievements of the Greeks and work ethic of the Greeks was never the problem. So now once you get those reforms, I think the prospects are excellent. Thanks for your attention and your patience. Thank you.
Well, thank you very much to both of you. First of all, let me apologize for not being Greek. I don't know why a Greek moderator couldn't be found for this discussion. Apparently, I was the best they could come up with, but
You're pretty good.
It's a privilege for me to take part in this discussion. I found these presentations interesting. And one of the preliminary point I'd just like to make is that you really should read this book. It is, I think, an extraordinary book because it combines a memoir, so you get to know Charles, with an extraordinarily detailed and rigorous account of the debt crisis, how it arose, how it was dealt with. I mean, to many non-specialists, that will sound a little off-putting. You know, give me the memoir, but not the debt stuff. But it's woven in so skillfully, so readably. I just inhaled this book, and I really do warmly recommend it to you.
Hear, hear.
Let me start. I'm going to ask a couple of questions, and then there'll be an opportunity for you guys to ask questions from the floor. First of all, Greek prospects. I've never heard, Charles, I don't think I've ever heard you be quite so optimistic about anything as you were about where the Greek economy now stands. I think if you as like, I don't need to tell you how much I admire your work, but I think if you as sort of pessimistic by nature, you see the downside in almost every economic situation, and usually you're correct. But now you're optimistic, and
that worries you.
it does. I mean, is it too good to be true? So, the other Charles, let's start with you. Do you share this optimism? Let's just have 2 minutes about Greece's prospects. Have they done enough to give them a secure, prosperous future?
Well, Clive, it's great being here with you and Charles, and I enjoyed very much your presentation. I think Greece still has a lot of work to do. I share in broad terms Charles's optimism, but I think it would be a mistake for any of us to underestimate the challenge that remains to create a truly 21st century competitive economy here. Because for so many years, this economy, as Charles pointed out, was riddled with inefficiencies, riddled with corruption, riddled with layers and layers of patronage. And those things don't change overnight, which is why I continue on every occasion I am there to come up with my shopping list to share with the Prime Minister or the Deputy Prime Minister about reforms that remain to be done. Legal reform is a crying need there. You can't resolve commercial disputes in anything remotely reasonable in terms of the time frames there. Further educational reform, public sector reform. It's still a bloated public sector. My wife, Pijing, and I went on a short cruise there in late summer of this year, and I went into one shop. It was toward the end of summer, how was your experience this summer? And how do you view the Greek government? Are they doing the right thing? And he said, it's a behemoth that I feel on my back every day. This is a small shopkeeper. Clearly, I think Mitsotakis has done a marvelous job of moving this country in the right direction. And I pay tribute to the resilience of the Greek people and the determination to go back and try their old parties again, even though they disserved them. But they knew that they were on a more dangerous and fragile course during those years with Syriza. My own view is this has to be persisted and viewed in generational terms to really transform this economy into one of the top economies of Greece. If you walk in Syntagma Square in Beijing, and I do that every time we're there, and we chat with people, and they think we're a little strange for coming up and asking them how they feel about the Greek economy. But we haven't been attacked yet.
I can see that.
Maybe because they don't remember who I was as a representative of the banker. But the story is still a difficult one.
Yeah.
You know, we feel that there's a real issue of affordability in this country. Go talk to Greek citizens who are trying to make ends meet. So there's still a lot to be done.
Let me just ask if I can follow up on when you have these conversations with officials, you obviously have splendid access to senior Greek politicians and ministers and so forth. Do you find they're receptive to the points you're making?
They are, yes. The leadership, in fact, I would even say they appreciate being encouraged to move in this direction. But that doesn't mean that the political systems around them are completely shed of all of these old habits. I think it's important to recognize that the political structures are still there. The patronage, the fact that the average citizen in Greece today might still be willing to tolerate a bloated public sector as long as you hire 3 of his cousins. Yeah. And that is there needs to be continued evolution in the relationship between civil society and the government.
Yeah, Charles.
Just to explain, because we don't disagree at all.
Right.
I didn't mean to make my optimism about the sustainability of Greece's membership in the Eurozone mean that reform's done. I would say a couple of things. First, reform is now owned by the Greeks. They believe in it. Right? It's working. Its success is visible. And so I think the trajectory is positive, but I agree with it. It's far from done. And I do know a lot of people who, for the first time in their life, are paying taxes, and that warms my heart. The final thing that I would say is...
Even if it doesn't warm their hearts, but they're doing it. You're right.
I would say one more thing. Remember what my point was. Not that Greece was going to be the highest growth economy in the world, but that Greece is now on a sustainable path relative to the Eurozone. Right. Now, part of the reason for my optimism is that the center countries have deteriorated.
Yes.
Okay, so it's an easier hill to climb. By the way, where is the debt default going to happen next in Europe? France. Yeah. Right? Yeah. And then how does the Eurozone survive? Yeah. That's what we need to be thinking about. So it's a big part of my optimism about Greece's ability to stay in the Eurozone is coming from the deteriorating situation. So the fiscal, Germany has actually got its fiscal house in good order. France not. Yes. And the trajectory is horrible. And the politics is toxic. Right. So I think that's really the interesting thing.
Well, I want to come back to the European dimension in a second, but just sticking with Greece for the moment. you touched on a further question related to this topic, which I just wanted to crystallize, which is, do you take the view that Greek voters, Greek citizens, by and large, accept the narrative that the mess they got into was principally due to domestic policy mistakes, that they have now been largely corrected, we've learned that lesson, it isn't going to happen again? Do you think that mindset prevails in Greece?
It's hard to, for me, I'm a strict empiricist, and I haven't talked to enough Greeks to be able to characterize it. But I would say there's clearly a change in that direction from where they were in 2012 and 2013, when the cartoons
Yes.
in 2013 were German tanks showing a parallel of World War II and what was going on in Greece at that time.
Yes.
By the way, I visited, when I was there in 2013, the IMF's resident representative there, a Dutch fellow whose name I won't mention, but he was under death threats. There was actually a conspiracy to destroy him and his home, which was uncovered and thwarted. And I met with him at great length, and his view was there is no willingness to do the reforms that are needed. The politicians pass the law one day to get something from the IMF and the ECB, and the next day they reverse it. And so it was a completely different environment. From now, you have demonstrated success of the Mitsotakis government.
Yes.
So, and I think people realize that, blaming Germany for their problem, I mean, there's a certain share of that Germany deserves, but it's a small share.
Yes.
So I think, I don't know, others can disagree with me about that, but I think the mindset has changed a lot since 2013, 2014.
And you go along with that?
I broadly do, but I do think that the government still needs to understand that even as we approach another pre-election, as we enter another pre-election period here, that the irony, and it was pointed out in Charles's presentation, the irony is that the more you accelerate reforms, the more the benefits of this will spread through the country. But in order to do that, you have to be willing to break through pieces and bits of political resistance who don't want to see change. And both these parties, well, there are now multiple parties there, they're still riddled with old school habits. And I think the Greek citizens are more ready for change than some of the old guard in these political parties. There has to be a sustained attempt at building on the reforms, further tax changes. They've got capitalization of equipment in industry is still woefully out of line with the rest of Europe. So if you want to build a plant in Italy relative to Spain or Portugal, and I know my company looks at this stuff, the tax capitalization policies in Greece are much more punitive and much less favorable than they are in other European countries. That's only one small example. The legal system in Greece is one of the worst for resolving commercial differences that I've seen. There's a lot that still needs to be done in the country, and I think that if the government will redouble its efforts here, I think that this current leadership has an opportunity really to move forward in this transformative period here. And as Charles pointed out, the rest of Europe, so much of Europe is struggling now. I was just in Berlin, and I actually had a feeling that I've never had before. I felt sorry for the German government because they actually are almost a bit lost, whereas Greek has stable leadership. They know where they want to be in terms of the overall global political environment, and they know the direction they want to pursue. It's just a question of how rapidly and how forcefully to pursue that. I hate to say it, but I share Charles's concern. If there is a building debt crisis in Europe today, it is France. They are lost both politically and financially at the moment. It's not lost forever, but unless they get on a track of fiscal discipline, they're going to be in crisis. And Europe is not prepared for that.
Yes.
Neither the IMF nor the Eurozone is prepared for that. I'd like to say, before we wrap up, Clive, I'd also like to say 2 words of thanks that I should have mentioned earlier. One is to gentleman on the third row over here, Arthur Klebanoff, who was willing, as a publisher, willing to take a chance on a first-time author. And his publishing house, Rodin Publishing, did a marvelous job in supporting me throughout multiple drafts in multiple years. So thank you very much, Arthur, for that. And another word of thanks to my wife, who tolerated not only 2 endless years of negotiations, but almost a decade of working through drafts of my book as well. So that is both appreciated very much.
I'd like to ask one more question, and then I'll see if there are any questions from the audience, if that's all right. So I'm have a think about a question you like to put. But one of the themes that recurs throughout the book is that the responsibility or the causes for the Greek crisis need to be understood on 3 levels. There's a global dimension, as it were, a multilateral dimension, where the IMF is deeply implicated. Then there's a European Union dimension. You write a lot about lack of solidarity at critical moments. And in effect, Greece had the worst of both worlds. There was the assumption that the solidarity would be there if it was required to deal with the debt crisis. And then when the crunch happened, it wasn't. It would have been better if people had assumed, actually, the EU is not going to bail Greece out. That would have forced the adjustment earlier. So there's a European dimension. And then, as you say, there's a Greek dimension, Greek policy, things that the Greeks needed to fix for themselves. Let's just spend a moment on the European dimension. I mean, I'm very preoccupied at the moment, as you can imagine, with the complete disarray in Europe's understanding of its future, generated principally by this administration in this country, raising questions that people had never imagined would be raised. And one can see that this will, as it were, catalyze efforts in Europe to develop, to solve some of the problems that you and Charles have highlighted, right? Lack of a banking union, lack of a systematic, well-thought-out debt restructuring policy, even now. The Draghi report, and this layer upon layer of useless bureaucratic regulation that's holding the country back and holding the whole zone back, and all wrapped up in, as it were, a failure to do what you need to do to make the EU a success. I mean, the fundamental point would be you've got a monetary union and still, even now, no fiscal union. Right. So I'd just like to ask you both if you feel in the chaos that we're living through right now in geopolitical terms, are there grounds for hope that Europe will finally get its act together in these respects and repair some of the things it needed to repair, but it hasn't yet? Banking union, capital markets union, fiscal union. Do you see signs of progress?
I'm happy to talk about that. I served for 3 years on what was called the Advisory Scientific Committee of the European Systemic Risk Board. And I got to see European bureaucracy from the inside, and it wasn't pretty. And that same the tail wag the dog kind of thinking was, well, we'll set up the EU, we'll set up all these aspirational sort of structures without actually mechanisms that ensure that compromises will actually be met. So there are some, I guess, some positive things to say. If you're going to have some kind of credible bank regulatory system, you need to get out of the dynamics of the domestic government and the domestic banking system. Yes. So basically, here's the deal of Europe until very recently. The European government will pretend that the banks are solvent, and the banks will pretend that the sovereign debt is worth something.
Right.
That was actually the conclusion of the Advisory Scientific Committee when we looked at the way the dynamics were being done. And how do you break out of that? Well, you have to create centralized accountability by giving the ECB more regulatory authority, which has happened.
Yes.
Right?
Up to a point.
Up to a point. And that's, so I'm just saying, but if I had to say, am I convinced that the institutions are moving in the direction of this sort of centralization, I would say I'm not really convinced. But I also want to point out there's never been a real democracy consensus about the creation of the EU. The EU is not a democratic outcome. The EU is an administrative state, politicians deciding that they want to create a structure that when put to referendum frequently isn't very popular. And so I think there's a long-term question of whether there's really a commitment to ceding national authority for a European kind of centralized authority. I'm not sure how I would feel if I were a voter in that situation, because I don't have a lot of faith in Brussels. And so as a European bureaucrat, I would say I didn't get a lot of reason to be optimistic, although I can point to some things.
Right, okay.
You know, I'm more optimistic about Greece than I'm optimistic about Europe.
Huh.
And I think that
very interesting.
it has partly to do with Brussels. The whole mechanism of the way in which the Commission in Europe operates administratively, organically, is broken. It almost needs to be stripped down and rebuilt, which is impractical. Yeah. But here we are, 4 years almost into a Russian invasion miles from their own borders. You know, put aside for a moment the totally legitimate concerns that you two shared over lack of monetary, lack of fiscal union, lack of capital markets union, lack of banking union, the obsessive administrativeness of Brussels, which makes Washington look like a purely clean and efficient bureaucracy.
Takes some doing,
They don't. There's not one country in the heart of Europe that has the sense of realism to reinstitute the draft. If you go into Northern Europe, sure, the Finns and others are on the front lines, and so they're doing it. But a poor senior French defense official was roundly criticized for having raised the issue of whether or not we're prepared to put our young men on the line here. I think this is a region that still lives outside the world of reality, and it's got so many threats. You know, they're letting the Chinese economy beginning to eat them alive. And while I'm not a great enthusiast at all for Trump's tariff policies, I think the fact is now they're dumping more and more product into the European lap, and they're going to undermine what remains of the European industrial base if Europe is not careful. Yeah. And yet Europe says, oh, we need to keep our markets open because we still sell a lot of stuff to China. There's so many problems with Europe. If they aren't approaching a reality check now, given what's happened with Ukraine, given what's happened after COVID, given what's happened with their energy crisis. I mean, I spent time, I mentioned recently in Berlin, and with the energy ministry, with the undersecretary there for energy, and they are trying to recreate an entire whole cloth of energy policy. Whereas Greece, as you mentioned, Greece knows where it's going on energy policy now, and they're doing a good job now. So I wish I were more optimistic about the future of the union, but they're unfortunately, even after a year of dealing with Trump too, and all of these other problems on their borders, there's still not an adequate sense of realism about how to clean up Brussels or how to reinvigorate the whole region.
Okay, well, thank you. That's certainly a remedy for the excessive optimism, yeah.
Sorry about that.
Are there any
Well said.
questions from the floor? Is there a microphone?
Thank you. My name is John Metaxas, formerly of Bloomberg and CBS, and formerly with the Holy Trinity New Rochelle Choir, where, Charles, we sometimes sang together. It's good to see you.
Good to see you.
It seems to me, and I was very happy to hear Dr. Dallara talk about the affordability issue. And I have no doubt about your thesis about how admirable this recovery has been. It seems to me, if I'm correct, Greece had the best or second best performing stock market last year in the Eurozone. But at the same time, there seems to be a disconnect with the lived experience of so many Greeks right now. If my memory serves me right, the average wage in Greece is 1,700 euros a month. If you're a young, educated Greek, 700. Okay, thank you for correcting me. That's even worse. If you're a young, educated Greek and you want to make a Northern European salary, you can easily go to Northern Europe. But if you don't have those options, you may end up being a waiter at a taverna or delivering food on a scooter. Those hotels, those world-class hotels that you talked about, are putting benches they're slathering the beaches with benches and charging sometimes 80 euros in some of the more expensive islands. And they're rendering a vacation in Greece unaffordable for many middle-class Greek families. It seems to me, anecdotally, Greeks don't really invest in stocks and bonds, but they have a lot of houses that they inherited from their uncle and their grandmother, and they've been systematically selling them to Chinese, to Israelis, to Americans, to Germans, maybe even to those world-class hotels that you talked about. So there's this disconnect, and why is there a disconnect between the great success story and the lived experience of so many Greeks today?
A couple of thoughts, and then I'd welcome to hear Charles here. I think you put your finger on something here, which is why we take our walks in St. Thomas Square. The Greek economy was pushed so hard, so far down, that individuals throughout the country are still trying to crawl back to a level of real per capita disposable income that they had in 2008. This is how severe this crisis was. So some of it is still crawling out of the depths of the economy. And I think it's so easy to get lost a little bit in the froth of, oh, they're investment grade rated now. Oh, there's a lot of investment coming in. Well, it's no small achievement to have restored themselves to investment grade rating, but at the same time, that does not deny what you just pointed out, which is there needs to be a continued acceleration of reforms so that those individuals that you refer to, and I meet them every time I'm there, and I have friends that are in that position. You know, I still like to go shopping in Plaka, and I ask all the shop owners how they're doing, how's the income? And, you know, it's still a very mixed bag there. They're struggling. They have 4 or 5 different family members there they're trying to support in one shop. And they're making a decent profit, but it's nothing to write home about. You need a constant wave of reform every year there to get this economy operating at a level of efficiency, a level of non-corruption, a level of transparency that is really going to address this reality.
Yeah, I agree. The way I would put it, John, is when you have a crisis like this, and we have lots of examples of them, of a kind of unrealistic overvaluation situation, excess government subsidies to try to compensate for lack of competitiveness, there's nowhere to go other than you relax the constraints on wage adjustment, you get people to be poorer, hugely. There is no other way to establish international competitiveness when you're starting from a position of unrealistic sort of wage payments and unsustainable fiscal spending. So unfortunately, I think the good news of growth and reform leading to, you know, a positive growth trajectory and positive trajectory on youth employment, which is still not very good, and still, you know, per capita income still not very good, but that's kind of necessary to get to a reality that's going to be a positive long-run trajectory. So, you know, I don't think there's a contradiction. They're actually two sides of the same coin, unfortunately.
And I would say as well that tax compliance is improving, but it still has some ways to go. And the fact of the matter is, I still don't see, and I hope I'm not stepping on too many toes here, I still don't see a lot of the profits of the ship-owning companies ending up paying taxes in Greece.
Let's take another question.
May I? Yeah, thank you. Nick Karambolis from Washington, D.C. Except for Denmark, Greece is the only EU country that faces an existential threat. From Turkey. And the overflights have begun again recently. My question is, the defense minister has engaged now in a massive reorganization, refitting of the Greek military. How will this massive expenditures, unprecedented in Greek history, affect the prospects going forward? Will money be diverted into defense from what should be servicing the memoranda? Thank you.
I would say that this is a welcome move by the Greek government because sadly, Turkey remains a huge area of threat and risk for Greece. And I would say that it underscores the necessity of streamlining the government and ensuring that government funds are spent efficiently, honestly, transparently. You've got to eliminate the corruptness that we saw in the agricultural sector there in the last few years with these massive subsidies fed into parts of the agricultural sector. You've really got to get serious about how money is managed on behalf of the Greek government. And this government is trying its best. But I think that this defense challenge underscores the necessity. And frankly, what's happened to Ukraine under the Russian invasion, it should be a wake-up call for all. But I'm glad to see the Greeks have spent, as you all know, a lot on the military over the years, but it hasn't always been the most modern and efficient military, and I think they're moving in the right direction now.
Yeah, I would add to that in addition to the direct threat coming from Turkey and the many unresolved issues between the two countries, that I think that Greece was very smart to get ahead of the curve of the rest of Europe in raising its military expenditure relative to GDP. As part of a geopolitical strategy to build its relationship with the U.S. And I experienced that when I was in Washington meeting with various Greek officials who came to visit, who after President Trump was elected were very keen to point out their expenditure on military relative to GDP, the fact that they were the ones who wanted to do a liquefied natural gas deal with the U.S. So I think Greece has smartly positions itself geopolitically with respect to the current American administration. And that's part of that military strategy, which I think is quite smart.
I'm not sure how.
We can have one question on that side.
Yeah. I mean, do we need to finish at a specific time?
Yes,
Do you want to make it another
yes,
10 minutes?
because I would like to
we can,
invite you
sure.
after that. I mean, we would like to invite you to a reception upstairs where we'll have Greek meze also.
So time
But
for one
we
more
have
question.
time for 1, 2, 3 questions.
Oh, okay.
So, hi, Anthony Lazanas. I'm the head of investment research at Bloomberg. So, I want to follow up on the first question. So, I have no doubt that there's a necessity to make people poorer in order to attract capital and grow. However, that translates into a political risk, right? Mm-hmm. Elections are not too far away, and we may have instability or a different government that will undermine the future. So, and also the current economy, right, and the technology concentrates wealth to capital rather than, the workers, right? So how can the Greek government sort of address this issue? Do we need an understanding with the investors that we need higher corporate taxes, and please keep your money in Greece because that will be sustainable? Can you comment on that?
That's a tough question. It sounds like that's one for you.
Can you summarize it? I couldn't quite hear it.
I think, if I understand, you're sort of wondering, in a political environment where labor is getting less of the rewards immediately from the reforms, how do you sustain the reforms? That's how I hear you.
And the role of corporate taxes in particular in doing that.
Yeah.
Higher corporate taxes, are they going to be necessary?
Well, I think the government has instituted this past September some modest changes in the tax structure which reach into the lower levels of income, which I think was a welcome move. So I think there's a bit more take-home pay there. But I think you have to recognize that wages will only rise with productivity gains. And I think that everything needs to be done to strengthen the overall efficiency of the economy. This is why I come back to the fact that they've made some improvements in the quality of public sector hiring, but there is still a tendency. I have seen parts of the bureaucracy in Greece which were so incompetent, and I'm not talking about today, but during my time there when I was negotiating the Greek debt, that dramatic changes still are needed to improve the overall efficiency of government. It doesn't have to be this kind of maniacal Doge operation that we saw here earlier this year, but it does need to be a focused effort to improve the overall quality and downsize and tailor the public sector in Greece. And I think that, again, a new relationship between the people and the state, but also there's still too many layers of complexity and permitting that need to take place before starting new businesses in Greece. I think that there's no easy short-term solution to these challenges. And I reiterate that what Greece faces is a generational challenge. But if they stay at it, a decade from now, you're going to see these real income levels really beginning to rise, and you're going to see pockets of efficiency replacing pockets of inefficiency in a dynamic Greek economy. But you have to remain shoulder to the wheel.
So I agree with everything you said, but his question's harder. His question is, what can you do to create patience during the short term? And so I'm going to give you a real answer to that question, coming from an example. So the most successful transitional reform message came from a socialist professor who became the president of Brazil in the mid-1990s. And what Cardoso did was, he said, every politician who's ever talked to you, this is real leadership, said every politician who's ever talked to you has lied to you and said, you can solve poverty in 2 years. We could solve poverty during this election cycle. And that's nonsense. But they lie to you, and then they blow up the fiscal account. You get inflation, and you're back to even worse poverty. He said, here's the solution. Let's combine fiscal long-term responsibility, real deep reforms to the fiscal policy. Let's combine it with visible social inclusion policy. So what did that mean? That was very practical and extremely successful. And despite the ups and downs in Brazil, it held. Because he did concrete things in the short term that changed the way government spent money to show that he was interested in inclusion. What were they? Paying mothers to have their children go to school. There was no short-term benefit to the economy from doing that. There was a generational benefit. And the Brazilians got it, they saw it, they believed in it. So what you have to do, and by the way, this is the same thing right now, everyone's talking about Venezuela, talking about what a great success Venezuela was just prior to Hugo Chavez. What a load of garbage that is. Okay, the poverty rate in Venezuela in 1999 was 50%. There's a reason Hugo Chavez came to Venezuela. The reason is because there was no commitment to social inclusion. Social inclusion doesn't mean socialism. It doesn't mean throwing money at everything. It means being selective and honest and having a leader who can convey what real long-term inclusion means and get people to believe in it. That's the answer. How often does it happen? Almost never.
Can we have one more question, because this gentleman was waiting, and then we will close.
Thank you. My name is Savas Mavridis. I just want to bring us in 08 into 2010. So I was at Bear Stearns in 08, and I subsequently spent 6 years at Lehman Brothers unwinding their bankruptcy. In 2010, has there ever been a study, and I would like to maybe challenge this, from a legal perspective on the bonds themselves, could they have been challenged? Because post-Argentina's default, sovereign debt did have legal clauses for default capabilities of these countries. So has there been any due diligence or post-mortem analysis? Could Greece have taken this to a legal challenge in default of their bonds? Number one. And part two to this equation is, when Syriza took power, should the capital controls been enforced in January of that year versus June, when they effectively had no leverage in controlling their funds available inside the country? So it's a little bit of a harder question, but it's more of a legal question, if that has been challenged and reviewed from a legal standing, with allowing default, and number two, not forcing Greece out of the euro. Thank you.
And the answer has to be 1 minute.
Read the book.
I have an answer.
Read the book.
Well, let me go first. Let me try. So Charles will correct me because he actually lived this, and
Yeah.
I may be getting this wrong, but here's my recollection. The biggest exposures on the private debt side to Greece were coming from probably the French banks. And if you had tried to impose sort of walking away from all of that debt, it would have been very hard to negotiate assistance from your European partners, from the ECB and also from the IMF. But my recollection is, from a legal standpoint, the majority, I think vast majority of the Greek sovereign debt was adjudicatable in Greek courts, which means that if they had decided to play hardball, unlike the Argentines in 1999, because their debt was adjudicated in London courts, Luxembourg courts, but I believe that the Greeks could have pulled it where they could have effectively reneged on their debt by using their domestic court control. But that would have then led to huge problems with the rest of Europe. So I think it's a possibility. They saw it, but they walked away from it for good reason. What do you think?
Well, I think that's broadly correct. I do think that Greece looked at this possibility, but they knew that such a confrontational approach would leave them outside the realm of global capital markets for years and years, just as it did for years with Argentina. Right. Some of it was adjudicatable in Greek courts, some of it in UK, but the reality is that there is real value in a negotiated solution for long-term relationships with capital markets. We have this expression of a voluntary negotiation, and some didn't like to hear it. Even within the Greek government, the advisors kept telling Greece they could pursue a cram down. And my resistance to that was very strong, including with the IMF, who at times was tempted with a cram down, where Greece would simply say, this is what we're doing. We're paying you 20 cents on the dollar. Ultimately, Greece got a hell of a good deal by the fact that at the end of the day, the creditors only got 27 cents on the dollar, which compared to all the Latin American restructurings was a great deal for Greece. Partly it's because things were dragged out, and we finally convinced the bankers that this was the size of restructuring, the size of a so-called haircut that they had to take in order to preserve the broader comity of the European Union. And ironically, many of these bankers, and they had grown up believing in the Euro project, believing in the Eurozone, and they did not want to have, as part of their legacy, ripping Greece out of the Euro. And that was a real fear. And frankly, I think it could well have happened. And then I think Greece would have been in deep trouble for decades to come. So this was something that legally probably could have been pursued, but wisely the Greek government moved away from it. And I think that one prime minister after the other reaffirmed that, even though Syriza came in with the idea that we can just walk away from some of this, but it never happened.
And just to confirm what you're saying, the academic evidence is hugely on the side of that countries that do these kind of unilateral walk away from it, they have very protracted periods before they can access the markets again, and then when they do, on very high spreads. Yes. So it's absolutely clear.
Let me just underline what I said before about reading the book. Do read the book, because this issue is treated at some length. This dilemma that the Greeks had to cope with is treated at some length in the book. Very, very enlightening. So I think,
Yes. So we jointly are going to thank
right.
everybody, right?
You're pulling the hook.
You know, it's a packed house, and we probably could have gone all night, but there is a reception that's very nice upstairs, so please join us, and you can continue to harass the
Yes.
panelists.
I know there's a lot of questions still there.